Hi, thanks so much for tuning in to BQ Prime. My name is Alex Matthew, and we're talking about something we don't talk about every day, which is bond yields. And we're talking about this in the context of the big event that took place overnight, and that was the outcome of the latest Fed meeting. It went as per most expectations, and the Fed decided to hike the policy rate by 25 basis points. But more importantly was the perception of the commentary that came about, and a lot of interpretations that are building that say that there could be a pause from this point out. There could, in fact, have been the last rate hike that we saw overnight, in this cycle at least. But in India, we've seen that bond yields have moved very sharply on the downside. In fact, the 10-year benchmark saw the yield slip below 7% very briefly. It has recovered past that once again. We're trying to understand what this context is and where bond yields are heading from this point on. Joining me to make sense of all of this for both you as well as me is Sandeep Yadav, Senior Vice President and Head of Fixed Income at DSP. Thank you so much, Sandeep, for taking the time. I will start with this question in that we've seen the 25 basis point hike by the Fed, the indication of a pause next time around, more or less as per expectations. Why are we seeing such a sharp move on the downside for bond yields here in India?
Well, that's a very good question, Alex. And frankly speaking, I think the bond yields have given up most of the gains today. So we are in negative territory when it comes to the price terms. But having said, yes, you're absolutely right. We have seen a significant rally in the bond yields in the last couple of weeks. We have seen 7% breach, which a couple of months back, hardly any bond participant was talking about. Yes, we were talking about, but then we had a different view. And I think the large reason is this. A lot of market participants did not buy bonds in the end of last financial year because they were worried about supply concerns, making yields go higher at the starting of this financial year in the month of April and May. And those fears did not get realized. And so many participants were sitting very light on bonds or they were not invested. And suddenly, when they saw that the bond yields are not going to go over 7.5 or 7.40, I think many participants have covered their risks. Of course, apart from this, a lot of other data points have converged together. So we have seen a banking crisis in US. We have seen inflation coming up domestically as well as globally. So a lot of these things have come together. Brent is at a year's low at close to $70. So a lot of these things have converged together, but India's domestic scenario where a lot of people were not invested have decided to invest in bonds, and that has led to the recent rally.
Interesting, because even as we speak, we're seeing that bond yield tick up on the 10-year. It is now at 7.04, not too far away from yesterday's close, I believe. But even a month and a half back, when we were talking to bond participants, and you mentioned this, it's rallied faster than expected. But then they were looking at fair value at 75 basis points above repo, which is far from where we are right now, even at this juncture. So it's interesting that it has hit that level. Is supply the only factor, or are we anticipating that the Fed perhaps will have to move to pivot faster than was previously anticipated?
Absolutely right, Alex. And let's face it, in US, markets are pricing in a Fed pivot much earlier and much more sharper than probably what India is expecting from RBI's policy. But having said that, I think when you mentioned 75 basis point over and above repo, let's face it, the last two times when RBI paused and in fact just precluding the rate hikes, well, the spread between the bond and the repo was less than 50 basis points. In fact, if I'm not in one of those scenarios, the bonds actually came lower than the repo rate, just like we have in US, where long-term bonds are lower than the Fed policy rate. So when we converge these 2 points, then I believe 75 basis point was probably too much of a pessimistic levels vis-a-vis repo. And usually when we are in pause or even before we are a rate cut, and I'm not saying that RBI will do a rate cut, but I'm saying at least we are in a pause zone. And when you are in a pause zone, 75 basis point was anyways too pessimistic a spread. Currently, 50 basis point also seems a little bit pessimistic, seeing the way the world is blowing over. The way the world is blowing over.
Absolutely. But what if that expectation is wrong? We've been wrong about the Fed before. And I guess we believed what the Fed had said at the time when they said that inflation was transitory, and we've all seen what has happened since then, the array of 75 basis point hikes. What if the market is wrong? Have we moved too far to one side, and then do we see the other way movement if we see another hike? What is the base case scenario for you? Let me ask you that. What is the base case scenario for you, and what is the outside chance that the Fed in fact may not pause?
No, that's a very good point, Alex, because we've seen last 1 year, right? Market trying to second guess Fed and saying that Fed is wrong. They won't do the rate hikes that they're saying. And we have seen 2 year and 5 year and 10 year US yields sharply falling down only to reverse. And we saw the latest reversal in the month of March. Well, this time I believe it's wrong, and I have not been the person who's been saying that Fed has been wrong so far. I think this time, when markets are pricing in a rate cut, they are literally following the Fed. Previously, when markets were pricing in rate cuts, they were going against the Fed, and that I believe is the biggest difference. Our base case scenario remains the same, where we expect, even if Fed does not cut the rates, Fed remains on a pause, and we expect, probably US yields have already priced in the rate cuts, so US yields might gravitate a little bit higher if they need to. I'm not saying that that is expected. Base case, probably we will remain where we are in US yields. But coming back to domestic factors, I think domestically we are still being quite pessimistic when it comes to bond yields, the Indian bond market. In US, you see 10-year is trading 150 basis point below their overnight rate. In India, that is not an expectation. That's not the way we have ever seen it. I don't think we'll ever see that. But the fact is, we are still 50 basis point above and above the repo rate. So we are still not priced in a lot of negativity, which rest of the global bond markets have priced in. And coming from that, my base case scenario remains that bond yields are going to gravitate lower. The 6.5% anchor that we have on repo rate will probably by the end of this year gravitate a little bit lower, which will give more fillip to the bond yields. And the way I look at it, even if they are not going to gravitate lower, do I expect bond yields in India to rise up significantly? I don't think so. I think most of the macroeconomic flows, demand, supply, global scenarios have changed in the last couple of months. And if they can't move higher, there's only one place they can move, and that is lower.
Yeah, interesting that you point that out, because I was looking at the crude chart as well this morning, and it's at $72 to the barrel. Quite interesting. Not even talking about the crude that we're buying at lower than that level here in India. But let's talk a little bit more about the domestic factor, Sandeep, which is, you mentioned this at the start, supply. What is the change in the scenario that we're seeing in, past the month of April heading into May, that has changed the picture so dramatically? Because we were very clear that the government was going to have a very large bond buying program, a bond selling program, and that would indeed keep a base to the bond yields, that they wouldn't fall beyond that point.
I have two issues with that analysis, and I think the first part is that government increased the GSEC borrowing program by 8%, and our nominal growth is expected to be 12% at least. So, or let's say 12% base case. And then suddenly the bond supply is really not as big as compared to the demand for the bonds vis-a-vis the nominal growth of the country. On the other hand, I think a large part of negativity was people were expecting states to come up with significantly higher borrowing. But even if we look at the month of March, states were sitting with around 3.5 lakh crores of cash in the balance sheets. And there was really very little chance that they will come with significantly big borrowing at the start of the year. We believe that is the case right now also. As we said, we expect states for this whole financial year really not to come up with significantly more borrowing compared to last year. And when you add these two things, then suddenly, those couple of assumptions were probably incorrect, where supply was really expected to inundate the demand for the bonds this year. Of course, one of the worries was that credit deposit ratio, credit was growing at a very faster rate, and people were saying that banks will have to sell their GSEC holdings to give credit. But again, I'm not a big fan of that logic as well, because for banks, GSECs are non-funded in the way that if they're holding GSECs, they can always borrow the money from RBI and they give it as credit. So I believe a lot of the fears ended up being fears, and I think that is what it should be going forward in the year. I'm not really worried about demand supply for this.
Okay, so going back to your projection of how you see the yields moving, and I would like you to describe the entire yield curve as well and how that is expected to move. On the 10-year, you're saying that it could move lower from this point as well. Are you looking at 675 as a possibility? How soon does that happen? And how does the rest of the yield curve behave?
That's a very good question, Alex. And I'll tell you, I'm a little bit of a outlier on that front, because I really have targets in my mind. I'll be very honest. I'm just looking at the data points right now. And as I said, I cannot see bond yields going higher. And if you don't see them going higher, then you might as well remain invested. Put a gun to my head and I'll say, yes, 675, 680 is where I expect. And probably what will lead 675, 680, probably a very dovish Fed policy, probably a very, in fact, the first whistle that I'm waiting for is a negative employment data in US, because literally everything is hinging on that. A negative employment data means negative services inflation in US, and that is probably the last bastion when it comes to what is worrying Fed when it comes to what is holding the core CPI higher, core PPI higher over there. So that is probably the number that should lead to the next fall. Having said that, liquidity is already becoming a little bit of a concern right now in India. I'm not sure that we are going to see significant FX flows this year. So much significant that they'll be able to take care of the currency in circulation, which may go out later on in the year. And RBI might be forced to do OMO purchases of the bonds. That will, of course, lead to a little bit more rally. But where we are right now, I'll say I prefer being invested at 705. Most of our funds are sitting very heavy on the bonds. We continue to remain heavy on the bonds because we just don't see much of the risk of bond yields rising further. And one last thing, if I might say, is that there are black swan events, which I really don't know what can happen. Yeah. But when you have rate hikes for consistently long time, it does break some of the structural macroeconomic of a country. We have seen SVB happening. No one expected SVB to happen, but a lot of rate hikes, and we are suddenly seeing contagion risk happening right now. So there are always some black swans, which none of us can predict, and better to be invested rather than to be out of the market in such a scenario.
I must point out that I have no guns in my hand, but I'm glad that you gave me a projection nonetheless. We have spoken about Fed. My last question will be, and I guess this is implied in what you've said and what you've described, but on the Indian monetary policy side, do you have expectations at all about when the RBI will move towards taking care of growth and therefore cut the rates?
Well, Alex, the growth numbers are coming very robust, right? We're still not seeing concerns on growth. April tax was one of the highest ever at 1.89 lakhs. We saw the PMI numbers which came earlier this month, and those PMI numbers were again much higher than what economists had expected. So yes, the fears are that growth would probably worsen off, and government has also said that they expect growth to be lower than what they had projected. But right now, we are not seeing those concerns playing out. But more importantly, when it comes to the domestic factors, I think what I believe our monetary policy has done is it's worked in tandem with FOMC for the last 1.5 years. We saw RBI hike the rates on 4th of May, just a day before the Fed policy last year. Yeah. And they have literally walked in tandem, maybe a step lower. When Fed was doing 75 basis points, we were doing 50 basis points. When Fed was doing 50 basis points, we are doing 25. And now when Fed is doing 25, we had pause. So probably I'll still say that I would still look at FOMC. I will still look at what US Fed is doing before I say that our MPC will start cutting the rates. And probably the next policy is when Fed may turn out to be a little bit dovish.
Interesting. Okay, we'll watch for that.
Do a rate cut, which I don't expect.
Yeah, we'll watch for that. And as you pointed out, the key data point to watch would be the jobs data from there. But thank you so much for taking the time, Sandeep. It gives us a lot of clarity, and always a pleasure speaking with you.
Alex, thank you.